Hey, what's going on, everybody? It's Spencer from Gray Capital. I want to talk about one of the most interesting investment opportunities in 2022 while we're seeing an incredible amount of inflation, all kinds of uncertainty. People aren't sure what to do, especially if they're looking at, placing some capital. What's a safe place to put it? They're not going to see a bunch of volatility. The stock market, it's been all over the place, an incredible amount of losses. We're in full bear market territory. The tech sector has been completely destroyed. Bonds are at a loss. Most asset classes are not faring too well, with really one exception, maybe two. So commodities on one hand, but then really real estate, and specifically multifamily apartments and industrial assets continue to outperform, seeing an incredible amount of demand from users. So the residents, people who need a place to live, homes are too expensive, need a place that's a little bit more affordable. Then on the industrial side, tons of e-commerce growth, supply chains that are moving around. I want to talk about one investment opportunity that it's not a guaranteed return. There are really no returns on any asset class or any investment are truly guaranteed. But what if I told you there's a way to earn 10% in 2022 on your money without taking a lot of risk? Now, in an era of inflation and uncertainty, that's a tall order to really lock in that 10%, but there's a way to do it. And at Gray Capital, we've been working on a vehicle to achieve exactly that. My name is Spencer Gray, President and CEO of Gray Capital. We're a multifamily real estate investment collective and private equity firm. We buy large apartment communities throughout the Midwest with a focus on cash flow. And we've recently launched the Gray Fund. It's a $100 million equity fund. 25 million of that, or 25%, is made up what we like to call A-class units. So I wanted to get into what these A-class units are, why I think they're a really interesting tool to add to your portfolio, and why investors are allocating more and more to A units in the Gray Fund. So as I mentioned, the A units in the Gray Fund only make up 25% or 25 million. So what we're using is a dual class equity structure. So again, 25% of the fund are A units, where 75 are B. Now, we'll have a whole video talking about B units and how they're really designed for upside and the highest overall total return. I want to talk about the A units today, because that's where you have the lowest risk, but still really strong returns. So for our A-class units, they feature a 10% annual preferred return. I'm going to abbreviate as your pref. So that's a 10%, again, annualized return that's paid out every single month, equaling 10% for your return for that year. Now it's in a priority position in the capital stack. What that means essentially is once we pay expenses, once we pay our mortgage, the first units to be paid, or the first investors to be paid their return, are the A-class units. And until those A-class units, those members of the fund, receive their 10% preferred return, no other cash flow gets distributed to anyone else, including the GP, the sponsor, or the B-class units. That means in the rare event that we didn't just have the cash flow to pay everyone, these A-class units would be paid first, and so there's a much lower chance that that 10% would not be paid. But how do we do that? So if you remember, the A-class units, again, they're only making up 25% of the overall fund equity. What that means is, in order to deliver this 10% preferred return, the project or the properties and really the portfolio of multifamily assets that we're investing in only has to produce a 2.5% project level cash on cash return to deliver that 10% preferred return every single month. 2.5% is a very low bar, and typically we're cash flowing in the 5 to 8% range in the first year of operations. So really on the lowest expectations, we're kind of doubling the amount that's required to meet this 10% hurdle. So why some investors, especially if you are a multifamily investor, you're investing in a lot of deals, you may say, that 10% return, that's great to receive, but that's not as high as some of the IRRs that you might see as just being a regular equity investor, and certainly not as high as you'd see being a B-class equity investor in the Gray Fund. But if you want to compare it to other asset classes and other opportunities out there, the long-term average of the S&P 500, the long-term average is only 10.5%. From 1926 all the way to 2021. And that doesn't include all the tax benefits the real estate has, and that's not including the fact that you're going to be receiving this cash flow every single month, not just looking at kind of growth appreciation over time. So when we're really assessing kind of risk and reward, the fact that these A-class units are in that priority position in the capital stack, you're getting that cash flow every single month, and you're just about beating, or at least at par with, the long-term average of the broader stock market, it's really an attractive opportunity, again, especially in an environment of high uncertainty and high inflation. Where the A-class units really come into play is for an individual who really is trying to generate strong cash flow and income in a given year. So, if you're someone who has a bond portfolio, you're nearing retirement, or you're just trying to create that alternative stream of income, these A units are a great tool and a great way to do that. They can also be used as a tool inside a broader portfolio or inside of an investment into the Gray Fund to really tailor your risk and return profile. So let's just take a look at that. There's a quick diagram we drew up. You can look at this diagram on the fund pitch deck. But all the way over here on the left side, we have our A units, which again have our 10% preferred return, kind of blended preferred returns along the top, and then our breakdown, a ratio of A units to B units. So remember, the A units have a 10% preferred return. The B units, which we're going to go into in another video, they have a 7% preferred return in an 80-20 B member and GP split. After an 18% IRR, it switches to a 60-40. The B units, they're totally focused on growth. It's a higher risk investment compared to the A units, because once the A units, they hit their 10%, no more cash flow flows to those members, and all of that cash flow flows to the B members, which allows us to generate a higher return than you typically see on a normal real estate investment. So again, if you're looking at the A unit as either just one vehicle to produce great 10% cash on cash return, or as a tool to kind of build and tailor your own risk and return profile using A units and B units, here's what that would look like. Because a lot of times people aren't just focused on income, and they're not solely focused on growth. And again, these B units, they're projected to produce a 3 to 4 times equity multiple over a 7 to 10 year period. So let's say that you're mostly focused on income, but you want just a little bit of upside as well. Well, then the 3 A units to 1 B unit ratio really might be the sweet spot for you, because you're getting a 9.25% blended preferred return across the A and B units, but you're looking at really nice potential upside with kind of a projected IRR around the 12% range. Or you can kind of move up to even a more balanced approach, looking at 2 units of A, 2 units to B. You're getting an 8.5% blended preferred return, and IRRs are right at 14.75 projected. And again, you can continue to tweak this dial. I mean, almost see this as like a little gauge or like a knob. You can really dial in exactly your risk and return profile that makes sense for you, going all the way to the highest risk option, which is also the highest potential return, of going 100% B units. So you're going to have a 7% preferred return that accrues over time, but that may not pay out in the first several years. Now, again, it'll accrue, but at the time of refinances and sales, the vast majority of that cash flow will flow to those B unit members, giving a potential very high overall total return. So to recap, the Gray Fund has been designed for a lot of functionality, a lot of optionality, allowing you to create your own tailored risk and return profile. But just going back to the A units, they're all about income. They're all about income, receiving that 10% preferred return that's distributed monthly. So if you're trying to generate another stream of income, you're trying to get cash flow, maybe you're thinking about retiring, whatever the case may be, the A units are an asset class that you should strongly consider. And if you'd like to learn more, please get in touch with us. Go to gray.fund. You can type it right into your browser to indicate that you're interested, or you can pop on over to graycapitalllc.com. You can schedule a meeting with myself or one of our investment associates at Gray Capital. We'd love to have a conversation with you and to see if these A units or the Gray Fund in general is a good fit. Now, the Gray Fund is only open to accredited investors, and this isn't a specific offer to invest in the Gray Fund. If you want to take a full look and review our private placement memorandum and all of our other partnership documents that are available on the Gray Capital investment portal. I appreciate you watching this video. Again, hop on over to graycapitalllc.com or gray.fund to learn more. Get in touch with us, schedule a meeting. We're looking forward to partnering with you as we continue to purchase some really incredible multifamily assets. This is an incredible time for multifamily apartments. I think it's one of the most unique buying opportunities we've seen in the last 15 years. I don't want you to miss out on it. Again, hop on over to graycapitalllc.com to learn more. My name is Spencer Gray. Talk to you soon. Thanks.